Here with us with his own take, former Kansas City Fed president and current senior fellow at George Mason University, Tom Hoenig. I thought that the Fed was going to be okay when President-elect Trump said that he's cool with Powell, doesn't plan to fire him. And then Elon Musk tweeted earlier this week that the Fed is overstaffed. And I wondered if there's a conflict brewing between the executive branch and the Fed. What do you think?
Well, I think the latter point in terms of Elon Musk is one that should surprise no one. His new role is to cut wherever he can. And so the Fed is a big bureaucracy. It's large. And it probably is and should be looking at its own staffing levels, see if they're adequate or not. And I think pressure coming from the White House and Musk is not a bit surprising. We'll see how it turns out. The Fed is independent, and I don't know that he can dictate it, but it'll be a topic of discussion, I'm sure.
All right, well, that's one point. And then there's what Mark Zandi just told us from Moody's, that he thinks that the bond market is telling us that the inflation outlook is getting more worrisome into next year because of some of the Trump policies, that inflation has not only proved sticky, but with tariffs and some of the policies laid out, could go higher next year. Do you interpret the bond market that way, and do you think that's going to be a problem?
I think the bond market, yes, is worried about the outlook, inflation, and the pressure on the Fed to continue to lower rates, which would be involve their balance sheet as well. And I think that puts uncertainty around inflation just from their own policies. And remember, right now with the nominal Fed funds rate at 4.25% and inflation around 2.5%, the real interest rates around 1.75%, which is about equilibrium in terms of the so-called neutral rate. We're not causing more inflation, not taking it away. But in some people's mind, that's modestly easy. So the outlook for more cuts, that's uncertain. And with the interest rates where they are and the strength of the economy, we're going to have looks like another 3% fourth quarter, 3% third quarter. There's going to be a lot of momentum, and that will push inflation higher. The one positive in all this is that productivity has been strong, 2%. And if that continues, that'll give some relief. But I think the bond market is rightly concerned about the size of the debt, the growing deficit, and the impact that has on long-term bonds and what the Fed will do about it. Those are all question marks that don't have clear answers.
Well, let's dig into it a little bit more, Tom, and I'm glad you brought it up, politics aside, because what's done is done. And we added $7-8 trillion in debt during COVID. You could argue we needed it. You could argue we don't. It's over. Doesn't really matter. Yeah. $2.5 trillion in debt added this year in 2024. Trillions of that is up for refinance, I guess, for lack of a better term. Debt maturities, matures just like home mortgages do in the United States. The bond market has had this huge yield move in the last 2 months. Is the bond market going to be able to absorb the refinancing of $5+ trillion in new debt this coming year?
Well, the bond market can absorb it, but at what price? That's the question.
But fair point. Answer your own question.
Yeah, well, and when you look at the Fed, the government, it doesn't have the same disciplines on it that private industries do. You have to get a return on your money. Here, they just have to pay more interest and print more money to do it. So that means, and this is what the bond market, I think, is concerned about, that means there'll be pressure on the Fed to end its quantitative tightening sooner and even begin to buy longer term as well as short term debt from the government to keep interest rates from rising more than the Congress wants, more than people want, but in fact may be necessary if they're going to fund the government without printing more money. That's the challenge that lies ahead, and it's a big challenge.